equities continue to take the strength of this data in their stride? Do equities continue to say, we like the soft landing story, we're buying that, we're not going to be concerned about any delays to Fed cuts?
Well, right now, equity markets are very much responding to strength of the economy as well as strength of earnings, notwithstanding the fact that we have had meaningful hawkish repricing on the rate front so far year to date, going from 7 cuts at the beginning of the year to 3 cuts, give or take, right now. So I think as long as earnings continue to hold up, the growth story and the narrative of immaculate disinflation will continue to support market sentiment, which is why we remain risk-on in U.S. equity markets, leaning into where we have seen earnings growth, such as AI and tech.
Wei, good morning, it's Guy. Do you think, though, the momentum is going to start to slow? I guess, presumably it gets harder and harder to generate upside for these equity markets. What do you think the rate of change is going to look like? We've had a very strong start to the year. Does that continue, or do we start to maybe plateau a little bit here?
Well, we're certainly looking at a rising bar from here, given how well equities have done, not just in the U.S., but globally as well. So we have talked about the fact that so far it's been the earnings driving equity upside, but earnings have been actually revised higher in terms of expectation as well. So we're talking about, for the broader U.S. equity market, 11% earnings growth for this year expected, and the tech sector, 18% earnings expected. And even for the broader market, ex the Magnificent Seven, we're talking about 8% earnings growth expected for this year, which is higher than the levels that we saw in terms of consensus at the beginning of the year. So the bar is rising, which makes it harder to beat as we start earnings season. So I think you're right, Guy, that it's going to be harder to continue the momentum that we have seen so far. But we do see this year, which is also why we do see this year as a year of 2 parts. Beginning of the year, first half of the year, first part of the year, supported by immaculate disinflation, earnings strong, growth strong. But at some point, markets would wake up to the fact that we are in a world of higher for longer, inflation settling at higher level, and rates settling at a higher level than what we got used to.